Welcome back to the Bloomberg Edge. The scary I word may be back in the U.S. economy. We're talking about inflation, especially after those trillion-dollar bailout packages. And to talk about the concerns, Josie Ling has a closer look. Josie.
Hey there, Susan. Yes, Bank of Tokyo Mitsubishi UFJ says that the Federal Reserve needs to reassure investors that its asset purchase program can be unwound quickly. And that simply means squeezing out the hundreds of billions of dollars it poured into financial markets through buying assets to unfreeze the system after Lehman Brothers' failure. Now, if you don't squeeze that money out of the system, the money flood will eventually push up prices. What I want to show you, Susan, is that this chart already shows investors are already expecting inflation. The expectation of higher prices is measured by the 10-year break-even rate, which is the white line you see on the screen. Now, that's the premium in the yield on treasuries over their inflation-protected version, or TIPS. You can see that the white line has spiked after the Fed's massive buying spree or money pumping spree. That's the yellow line. Now, Bank of Tokyo Mitsubishi's view is not an uncommon one, calling on the Fed to, give us a plan. But what the chart shows you is that investors are now putting their money on it, buying TIPS or shunning treasuries. In either way, that's driving up the break-even rate. So that's the inflation expectations going up, simply to say that we are expecting inflation to kick in unless you, the Fed, do something to pull back all the money that you've been pumping into the system. Give us a plan. Back to you, Susan.
Well, inflation is good for commodities. Thank you for that, Josie Ling.